In this video, I'm going to expose my stock portfolio, explain what went wrong, and the steps that I'm taking to hopefully rebuild and come back from my £20,000 loss. Isn't it weird how in life you can have moments where you feel that you're making progress, however, when you look back upon your journey, you discover that you were actually stagnant in this time. Quite frankly, I needed a slap in the face from a wet blobfish. Unfortunately, this is yet to happen, and so I'll have to settle for some measly self-reflection. So what went wrong, and why did I end up losing so much in my portfolio?
Oh, but Mr. Market and the shorters manipulated the share prices of my stocks and made me, because I'm so special, lose all my money.
Nothing is to be gained from having that victim mindset. I need to be accountable for my actions, and honestly, I made some silly choices. So, what were they? Well, I believe that by holding a smaller number of shares, I could outperform the markets. It seems quite logical at first, but I used that as advice to put lots of money recklessly into one or two investments. To make things worse, these investments were pretty niche and they weren't that defensive. In fact, Boohoo's biggest competitive advantage was being able to sell clothes at a cheaper price than the competition, which essentially made it a commodity retailer, which went well until it didn't. I avoided traditional businesses and old world companies, believing that they'd seen the best of their growth in the past. I felt that a lot of traditional businesses were too big and complicated, and I avoided them. Recently, I've come to the realization that I don't need to know every grain of a business's operations, but understanding the general business model and really understanding the factors that can impact it, I think is much more important. If those two problems weren't bad enough, this next mistake absolutely destroyed any chance I had of long-term success that I thought that I could get. Perhaps it's a form of hubristic bias, but I thought the pandemic was the perfect storm to learn investing. As businesses dropped in price rapidly, I naively assumed that those that recovered quickly or the most were better quality businesses. Again, there is some flawed logic behind this. The companies that recovered quickly typically had good balance sheets or were in dominant positions. The problem was that these companies had egregious valuations, and I was led to believe that during the pandemic, when there was plenty of cash available, that a price to earnings ratio of 50 times could be considered fair. I thought that it'd be so unlikely that investor sentiment could change in a business that they looked so fondly upon. A combination of these mistakes really helped me take a step in the wrong direction and burn away a 10% deposit for a house in Stoke. Just kidding, I'd rather lose that money again than live anywhere near there. So what steps am I taking to rebuild the portfolio, and what lessons have I learned so far? Well, my diversification was comical, just like my videos from 2 years ago. I recently looked deeper into my industry and sector allocations, and when I say deeper, this is not advanced analysis. I found that I had a 68% exposure to consumer discretionary stocks. It's really no surprise in hindsight why I underperformed so badly in a downturn. So you might ask, what changes has been made to my portfolio, and what really have I done to build this portfolio better? So I've completely sold my position in Boohoo. I explained all my reasons for this last month. I then categorized all of my current holdings by industry and then quantified my conviction with each stock, aka how much of my portfolio as a percentage would I be comfortable holding in just one stock. And most importantly, to avoid repeating the overexposure mistake, how big of an impact in years will this stock falling to zero impact my long-term returns? For example, having an 8% position size of an investment, it would take a year at the average market return to recover those losses. Previously, my justification was that my income could supplement the losses and I could still help develop substantial positions over time. But this approach was extremely reckless and really accelerated the losses that I have made in this portfolio. A good example for this allocation strategy is watches of Switzerland Group. I like the valuation, but given the risk of their exposure to Rolex being their one major supplier and it's worth about 50% of total sales, I've limited my maximum purchase exposure to 2.5%. This is actually shared by Sylvania Platinum because I have a limited understanding in mining but acknowledge the geographical and commodity risks. Both Sylvania Platinum and Watches of Switzerland Group share high levels of cyclicality and justify the smaller position sizes. However, there is one huge red flag right now that will likely drastically impact the performance of my portfolio in the future, and it needs to be addressed in this video. This is my high exposure to Games Workshop. Currently, I have over 50% of my portfolio invested in shares of GAW. Now, I've had this for a long time, but it's hardly intelligent investing. And should an unforeseen problem arise, it could really hit my portfolio hard. I think Games Workshop is a cracking company. I think it is probably one of the best companies listed. I also think that at the moment Games Workshop is trading at a premium to the market, but it's not overvalued. I guess the easy solution is to trim the position and not look back, especially when considering how much damage this approach could have prevented in hindsight. That said, I do think there's some distinctive differences between Games Workshop and Boohoo. Perhaps the mistake was having a high exposure to one stock that lacked enough defensive qualities. Given that I'm full-time on YouTube and now reinvest the majority of my earnings back into the operations of my channel, it means that I likely won't be able to top up the portfolio ISA for quite some time. This again points out the risk of having such a large exposure to Games Workshop, and truthfully I don't have the answer yet, but I will keep reflecting on it until I find some conclusion. Those of you that have live access to my portfolio, there's a link in the description down below, and it is completely free, will already know which new stocks I've added to the portfolio, but I will cover them here. I've added shares of this next stock because I'm starting to believe that alcohol is becoming more addictive than tobacco and has less regulation. This business is very defensive, owns loads of well-known brands and has very strong profit margins. Shares aren't cheap, but they had fallen to an attractive entry point to open a position. However, I won't buy any more shares of this stock unless shares do fall by a larger percentage. Even though this is a quality FTSE 100 company, and yes, that just scared the life out of me, the growth is not going to be fast enough to justify a larger allocation in my portfolio. That said, my long-term allocation for Diageo is around 5%. This next stock is a business that I really liked in the past when it was much more expensive. Now it has dropped down to a very low level for such a high quality business. This provides the benefit of adding another defensive portfolio to my company, whilst also adding diversification into industries that I have completely lacked. It also ticks a lot of ESG boxes too, if that's what you seek. Given its quality, price and growth potential, I'm going to allocate 7.5% of my portfolio to Halma. When I sold my Boohoo shares, I knew exactly what stock I want to buy in its place. I have a 15% allocation and will stick to this exposure with this new company. This is an extremely agile company in an industry with plenty of growth potential. Whilst they are the second largest in terms of market share in the US, their long-term goal is to take 20% of the overall market, which would place them above the market leader, which is currently at 17%. In the UK, they are also the market leader at 13%. I also believe that I've bought shares of Ashtead Group at an attractive entry price that could generate some good long-term returns. But I bet you're dying to find out how much damage my portfolio has taken now that I've crystallised the losses with Boohoo and how I feel about this huge loss. Well, year to date, I'm actually doing better than the FTSE 100. Not that it's doing too well. It's down 2% so far this year, but I'm obviously lagging behind the S&P 500, which is up 14%. My returns are 10%, so I'm doing all right so far this year. Obviously, the bigger picture is far from all right. I'm down 44% since inception, which not only loses to the S&P 500 of being up 77%, but also the FTSE 100 of being up 36%. You might want to get started investing for yourself, but aren't sure on where to start. Do I know of a good stockbroker to invest in? Well, yeah. Click this video here to find out the best investing app in the UK for 2024.